I explained in a recent video about the benefits of being able to flexibly access your pension savings after the age of 55 to meet a short-term income need or unexpected expenditure. However, there is one major consideration you need to take into account, and that's the little understood pensions rule known as the Money Purchase Annual Allowance. Most people, apart from high earners, have an annual allowance of £40,000. This is the maximum amount that can be put into your pension every year. But once you've made a flexible withdrawal from your defined contribution pension, the Money Purchase Annual Allowance is triggered, which is then going to reduce your annual allowance to just £4,000 a year. This £4,000 limit is for both personal and employer contributions into defined contribution schemes, and the ability to carry forward unused allowances ceases as well. So, if you access your pension while still working, perhaps to meet a short-term need, then there can be dramatic consequences for the future funding of your pension. Let's say that you had accessed your pension benefits at age 55, but had been planning to retire at 65. For the next 10 years that you're still working, your annual allowance for your defined contribution scheme will be £36,000 lower at £4,000 instead of £40,000. So you would be potentially missing out of £360,000 in pension contributions that you could be eligible for pension tax relief. Obviously, the real impact of the Money Purchase Annual Allowance being triggered will depend on your income levels, expected future contributions, and your time to retirement. It may be less of an issue if you're only receiving the minimum contributions under an auto-enrollment pension scheme, or if you're much closer to retirement. So, how do you avoid the Money Purchase Annual Allowance being triggered if you need to access your pension? Well, the answer is to only take tax-free cash from your pot. While a Flexi Access Drawdown Fund would be created at the same time, if no income is taken from it, the Money Purchase Annual Allowance is not triggered. Of course, the more tax-free cash you take before retiring, the less available at retirement, which you might have had a specific plan for. So, in times of crisis, a pension pot may be a very tempting solution to fund an increased household expenditure, but it is important to understand the consequences of accessing it earlier than planned. Rebuilding your pension retirement savings could be a challenge if your Money Purchase Annual Allowance is triggered. Seek advice from a suitably qualified independent financial planner to help you plan ahead and understand the consequences. Thanks for watching. I hope you've enjoyed this video. If you have, please press the like button now and of course subscribe so you never miss a future episode. My name is Justin King. I'm a chartered and certified financial planner, and I'm here to help you live a successful life. That often involves understanding your money. I host a podcast called the Retirement Cafe Podcast. You might like to tune into that. Check out the description below for a link to that. And of course, you can sign up for my weekly newsletter, which is packed with inspiration and tips for a successful retirement. For now, I'm Justin King, helping you live your best life.